Okay, let's dive in. Imagine being able to edit someone's DNA, like
Yeah.
actually go in and fix a faulty gene to cure a serious disease.
Yeah, the potential there is just huge, truly transformative stuff.
Totally. But then how do you actually evaluate the companies trying to do this? Especially if you're looking at it through a specific lens, like, say, Warren Buffett's value investing ideas.
That's exactly what we're digging into today. We've got this whole stack of source material here. It's a detailed stock analysis looking specifically at Editas Medicine. The ticker is EDI, and it's dated June 14th, 2025.
Right. And the whole analysis is framed using those classic fundamental value investing principles.
Exactly. So this deep dive, it's basically your shortcut. We're going to pull out the most important stuff from these sources so you don't have to wade through it all yourself. And Editas, well, fundamentally, it's a clinical stage biotech company all about gene editing.
Okay, and the sources really break this down for us, right? To different chapters covering the key parts.
Yeah, they do. They look at the business itself. Chapter 1 is business understanding. Then who's running the show in Chapter 2, management evaluation. Chapter 3 gets into the money side, financial health.
And this specific deep dive, I should mention, was actually requested by a member over at Stock Analytics AI on YouTube. It was a prioritized analysis.
Oh, right.
Yeah, so if you're interested in getting deep dives like this on stocks you're following, members there get priority for just $4.99 a month. And of course, all the sources we're using today, they're linked down in the description if you want the nitty-gritty details.
Good point. So, yeah, our mission today is basically to distill all this. What does this deep look at Editas through that value lens really tell us right now?
Precisely. And you want to stick around to the end because the analysis has this really critical takeaway about what Editas actually is as an investment, seen this way. It might surprise you.
Definitely.
Okay, let's start at the beginning then. Chapter 1, Business Understanding. What exactly is Editas Medicine doing?
All right, so Editas Medicine, Inc., founded back in November 2013, based in Cambridge, Massachusetts. And like I said, it's a clinical stage biotech.
Clinical stage meaning no products on the market yet.
Exactly. No approved products, no sales revenue from products. They're purely focused on developing potential medicines and, testing them in clinical trials.
Got it. And their main technology, the sources mentioned CRISPR.
Yeah, their whole focus is genome editing, primarily using CRISPR-Cas9 and also CRISPR-Cas12a. You can think of these like really precise molecular scissors, or maybe a word processor for DNA.
Molecular scissors, I like that. Helps picture it.
Right. And the goal is to use these tools to develop one-time treatments. Go in, edit the faulty genes causing severe genetic diseases, and potentially offer a cure.
Okay. Now, the sources make a really big deal about a major change, a strategic pivot they announced in December 2024. What was that about?
Yeah, that was huge for them. They made this decisive shift. They announced they were becoming a fully in vivo gene editing company. And that distinction is really, really important.
In vivo. What does that mean compared to what they were doing before?
So in vivo means the gene editing happens inside the patient's body. You give the therapy, maybe an infusion or something, and the editing happens right there in the target cells, inside the person.
Okay, inside the body. And the alternative is?
The alternative is ex vivo. That's where you take cells out of the patient, edit them in the lab, grow them up, and then infuse those edited cells back into the patient. It's a more complex process for the patient.
And this pivot to in vivo had some major consequences. They actually stopped their lead program, didn't they? Reni-cel.
That's right. They discontinued Reni-cel. That was their ex vivo program for sickle cell disease and beta thalassemia.
And the sources say this was even though the data looked good.
Yeah, that's the striking part. The sources note they had positive clinical data, described it as showing transformative results, even said it was comparably powerful to therapies that are already approved.
Wow. So why stop something that seems promising and powerful?
Well, the analysis points directly to the reason. They couldn't land a commercial partner for Reni-cel.
Ah.
Yeah, it really underscores a tough reality in biotech. Having good science, even a working therapy, it's only half the battle. You need a path to actually sell it to get it to patients. And for smaller companies, that often means a big partner.
And this pivot wasn't just about the program, right? It hit the workforce hard, too.
Oh, absolutely. Huge impact. They had a massive workforce reduction. About 180 jobs were cut, which the sources say was roughly 2/3 of their staff.
2/3. That's drastic. What was the thinking behind such a dramatic move?
Yeah.
Ditching a lead program with good data, cutting so many people?
Management's explanation, according to the sources, was about seeing accelerated viability and just greater long-term promise in their in vivo work.
So they think in vivo has a better shot long term.
Yeah, they believe in vivo could reach broader markets, maybe treat more diseases, more patients, and could also be less burdensome for patients compared to that complex ex vivo process. The sources kind of frame it as a pragmatic, tough decision. They had to preserve capital. This R&D stuff is incredibly expensive.
Okay, so if you're trying to understand Editas today, why is grasping this pivot so fundamental?
Because it just completely changes everything about the company. Their focus, their risks, the timeline, it's all different now. It shows management's willing to make incredibly tough calls,
Yeah.
painful ones, but it also really highlights those commercialization hurdles in biotech.
So the key takeaway here is that Editas today isn't really the company that was pushing Renacell forward anymore.
Exactly. It's essentially a bet built entirely around their in vivo platform and technology.
Right, that clarifies the shift significantly. So who's steering this newly focused ship? Let's move to Chapter 2, Management Evaluation.
Yeah, the sources definitely put a spotlight on the leadership team. Their experience, especially in genetic medicine and actually getting drugs through trials, is seen as critical, which makes sense, right, when you're betting the whole company on cutting-edge science.
And the CEO, Gilmore O'Neill, he came on board in June 2022. The analysis really flags his background.
It does, over 20 years of experience, and importantly, a track record of guiding multiple programs all the way to approval. The sources even name-drop examples like Spinraza and Tecfidera.
Having someone who's actually done it before, navigated that whole complex path from the lab to an approved drug. That seems pretty valuable for a company at this stage.
Hugely valuable. It's a major qualitative plus. It's not just about the science working in theory, it's about executing the clinical trials, dealing with regulators, the whole 9 yards.
The sources also mention some other key people. Linnea Spizzi, background in life sciences, rare diseases. Brianna Buckley, experience in clinical development, specifically rare blood disorders.
Right, which is relevant given their history with Renacell and potential future targets for in vivo. Lindsay Berkeley is highlighted as a research leader, lots of patents, suggests strong science internally.
And Amy Parison, the CFO, was an internal promotion. The sources kind of hint that might mean she has a really deep understanding of Editas' specific financial needs and challenges.
Yeah, potentially. And there's also mention of the board of directors, standard committee structure for oversight. The basics of good governance are there.
So for you listening, what's the bottom line on the management team here?
Look, in a company like Editas, all potential, zero product revenue, right now the team is arguably your most critical asset. Can they execute this pivot? Can they manage the cash carefully? Can they run the complex trials successfully? Can they navigate the FDA? Their experience, according to these sources, suggests they have the right kind of background for these challenges. That's a positive sign, especially given the big strategic shift and, frankly, the high risks involved.
Makes sense. Even the best science needs capable hands. Okay, speaking of needing things, developing these therapies needs a lot of cash. Let's get into Chapter 3. Financial health.
Right. And as we said, clinical stage company. So the financial story is really about spending on R&D and, well, not having any product sales yet.
The sources give us the numbers as of March 31st, 2025. What did they have in the bank?
They had $221.0 million in cash equivalents, and marketable securities. Based on how much they're spending, the projection is that this cash will last them into the second quarter of 2027.
Okay, so a runway of about 2 years? That sounds critical.
Absolutely critical in biotech. It's the clock ticking. Tells you how long they can keep the lights on and the research going before they likely need more money.
And the recent results, the first quarter of 2025.
Yeah, Q1 25, they reported a net loss of $76.1 million, which was actually up quite a bit from the $62 million loss in Q1 of 2024.
And that increase was mostly due to that big pivot, right? The restructuring costs.
Exactly. A big chunk of that Q1 25 loss, $40.9 million, was specifically tied to restructuring charges. Things like shutting down Renacell, severance for the layoffs, asset write-downs.
But underneath that one-time hit, were there any signs of improvement in their regular spending?
Actually, yes. If you look past those restructuring charges, the operating expenses did improve. R&D spending, for example, dropped to $26.6 million in Q1 25. That's down from $48.8 million the year before.
Mostly from stopping the cell work.
Primarily, yeah, though they are now obviously ramping up spending on the new in vivo programs. But the net effect was a decrease. And G&A, the general administrative costs, also went down to $13.4 million from $19.3 million. So the restructuring did lower their ongoing burn rate.
They also managed to get some cash without selling more stock, right? Non-dilutive financing.
Yeah, that was important. Back in October 2024, they got a $57 million upfront payment from Vertex Pharmaceuticals. This was basically them getting cash now for future license fees they were owed related to their Cas9 technology. Getting cash without issuing new shares is always a positive for existing shareholders.
Okay. And looking back historically, what do the financials generally look like?
Well, the sources describe revenues as fluctuating, mostly from collaborations and largely negative net income. Like, that FY 2024 revenue was $32.3 million, but profit. Consistently negative, operating margins, negative. That Q1 2025 net margin was like negative 778%, largely due to those restructuring charges, but still. Stark. For free cash flow, also consistently negative, burning cash. On the plus side, the sources note they don't have any long-term debt, which is good.
But there was something about a debt-to-equity ratio being high, 3.22.
Right. That sounds weird with no debt, but the sources explain it. It's not traditional borrowing debt. That high ratio reflects how much shareholder equity has been eroded by all the accumulated losses over time. The equity part of the ratio is way down because of the cash burn, making the ratio look high even without loans.
Okay, got it. So putting the whole financial picture together for the listener.
The story is clear. It's a company burning through cash to fund ambitious R&D, which is normal for this stage. They've made some aggressive moves, the big restructuring, getting that non-dilutive cash to cut costs and extend that cash runway out to Q2 2027.
So the million-dollar question, or rather the $221 million question
is 2 years enough time? Enough time for their in vivo pipeline to show really promising data. Data good enough to either attract a major partner with deep pockets or convince investors to buy new shares, likely diluting existing ones, before that cash runs out. It's definitely a race against time.
It really highlights the financial pressures. Okay, let's switch perspectives now. How does the market, the investment community see Editas right now? This is Chapter 4, Market Sentiment.
Right. And the first thing the sources point out is that because Editas has no earnings, your standard PE ratio, price to earnings, just doesn't apply. It's meaningless here. The sources literally show to get you.
So what metrics do they look at in the analysis?
They mention price to sales as context that was 4.84x on a trailing 12-month basis, and price to book PB was 2.82x. Interestingly, the analysis notes that these multiples are actually higher than the average for their sector.
Higher than average?
Yeah.
Even though they're losing money. What does that suggest?
It suggests the market might be giving them some credit for the future potential, pricing in the possibility of success with their technology despite the lack of current profits. It implies a certain level of optimism baked in.
Okay. What about the Wall Street analysts? What's their general view?
The consensus rating among the analysts covered is basically hold. Looking at the numbers, out of 12 analysts, you've got 4 with a buy, 8 with a hold, and notably 0 analysts saying sell.
No sells. And the price targets.
The average one-year price target is $3.38. Now, compare that to where the stock was trading around the time of this analysis, about $2.10. That target implies a potential upside of over 60%.
60% upside potential. That sounds pretty bullish from the analysts.
It does sound that way, on average. But, and this is a big but the sources emphasize, the range of those individual analyst targets is huge. It goes from a low of just $1 all the way up to $5.25.
Oh, $1 to over $5. That's a massive spread.
Exactly. That wide disagreement among the professionals tells you everything about the uncertainty here. There's no consensus on what this stock is actually worth or where it's headed. The analysis mentions some analysts cut targets after the pivot in late 2024, but then you saw some new buy ratings pop up in early 2025. It's a real debate.
And the stock price itself must reflect that volatility and uncertainty.
Oh, absolutely. The sources point to major swings. The 52-week range was from 91 cents up to $6.22. And over the past year leading up to the analysis, the stock was down significantly, over 60%.
But I thought I saw something about it doing better more recently.
You did. Despite that big one-year drop, the stock had actually outperformed the wider medical sector year-to-date in 2025. It was up something like 21.3%, while the sector itself was down about 4.2%.
Huh. So maybe the market started liking the new in vivo focus.
That could be it, perhaps reacting positively to the clarity of the new strategy, or maybe some encouraging preclinical updates filtering through about the in vivo programs. But it's still been a very choppy ride.
Okay, now here's a really interesting data point the sources highlight regarding market sentiment. Short interest.
Yes, this is key. It shows the level of skepticism. The sources report a notable short interest. 10.90% of the float, the freely traded shares, were being shorted as of late May 2025.
10% is pretty significant. What does that mean in practical terms?
It means a decent chunk of investors are actively betting against the stock, betting the price will fall. The days to cover figure was 4.79 days. That means, theoretically, it would take almost 5 full trading days for all those short sellers to buy back the shares they borrowed if they decided to close their positions all at once. High short interest like this signals perceived high risk.
And on the flip side, what about big institutional investors? The big funds.
They hold a lot. Institutional ownership is substantial, reported at 57.93% as of May 2025. So big money managers, pension funds, mutual funds, they own a majority of the company.
But did the sources mention any recent changes there?
Yes. They noted that mutual fund holdings specifically had decreased slightly recently. So while overall institutional ownership is high, there might have been some selling from that segment.
Okay, so pulling all this market sentiment together for the listener, what's the main takeaway?
The market is clearly divided, uncertain. You've got these analyst targets suggesting big potential upside, and major institutions holding large stakes. That's the optimistic view. But then you have that really high short interest showing strong skepticism, and the stock's wild volatility reflecting the debate. The recent outperformance hints maybe sentiment shifted a bit after the pivot, but the disagreement is stark.
So the market isn't valuing it on today's numbers at all?
Not really. It seems to be grappling with this huge uncertainty, the massive potential of the in vivo technology versus the very real risks of failure and the long timeline. It's a classic speculative biotech story playing out in the stock price and sentiment.
That push and pull is really clear. Okay, let's briefly cover Chapter 5. Ownership structure. You mentioned the sources kind of roll this into market sentiment, but let's just state the key point.
Right. It's quite brief in the source material itself. The main takeaway really is just reiterating that high institutional ownership figure. Nearly 58% of the company is owned by these large investment firms.
And what does that signal again?
Well, it shows that a lot of smart money professional managers have bought into the story, at least to some extent. But as we just discussed, that slight dip in mutual fund holdings and the significant short interest, it just reinforces that even among the big players, there's an active debate and disagreement about the company's future value. It's definitely not a stock everyone agrees on.
Good reminder. Okay, now let's try to synthesize all of this, the business, the leadership, the money, the market view, into a clear picture of the overall landscape. This is effectively Chapter 6, risk assessment, though the sources structure it more like a SWOT analysis implicitly.
Exactly. Let's break down the strengths, weaknesses, opportunities, and threats as presented in the analysis. First up, the strengths.
What does Editas have going for it right now, according to these sources?
Well, number one is their foundational intellectual property. Those exclusive licenses for key CRISPR-Cas9 and Cas12a patents, that's a major asset in this competitive field.
Okay, strong IP. What else?
Their proprietary in vivo delivery platform called SLEEK TLNP, that stands for Targeted Lipid Nanoparticle, is highlighted as a key strength. And importantly, it's backed by some promising preclinical data.
Preclinical data? Like in animals?
Yes. Specifically, the analysis mentions achieving 58% editing in blood stem cells, hematopoietic stem cells, or HSCs in non-human primates, NHPs. NHPs are obviously genetically close to humans, so that's considered very relevant data. And that 58% editing level actually exceeded the threshold scientists believe is needed for a therapeutic effect in those diseases.
Wow, 58% in primate stem cells.
Yeah.
That does sound promising. Anything else on the strength side?
Yeah, the management team we discussed earlier, their extensive experience in genetic medicines and actually getting drugs approved is definitely listed as a strength.
Okay, strong IP, promising delivery tech with good early data, experienced team. Got it. Now let's flip that. What are the weaknesses?
The biggest one, hands down, is that their pipeline is still entirely preclinical. Their lead in vivo program, the one they're pinning their hopes on now. They're not even targeting filing the paperwork with the FDA to start human trials, the IND filing, until 2026 at the earliest.
2026. So any potential product is still years and years away.
Exactly. Years away, best case. Then there's the financial side. The consistent lack of profits, the negative free cash flow, those are major weaknesses. The company's entire value proposition rests on future events, clinical trial success, regulatory approval, successful commercial launch, all of which are highly uncertain and unpredictable.
And the IP situation isn't totally clear-cut either.
Right. The sources mention ongoing patent interference disputes. That creates uncertainty around their core IP, even with those licenses. And finally, just the sheer amount of capital required to fund all this research is a constant pressure, a weakness.
Okay, long timeline, no profits, burning cash, IP questions, high costs. Those are pretty substantial weaknesses. How about the opportunities? What's the potential upside?
The market opportunity is definitely huge. The sources cite projections for the global market for hemoglobinopathies, sickle cell, beta thalassemia, their initial target area to be over $50 billion by 2032.
50 billion. That's massive.
It is, and the broader market for CRISPR gene editing itself is projected to grow significantly too, maybe exceeding $13 billion by 2034. And importantly, the sources note that the in vivo segment, where Editas is now focused, is the fastest growing part of that market.
So they pivoted into the hot area.
Seems that way. Plus, there's the opportunity to apply their sleek delivery platform to other diseases beyond the first targets. And those strategic collaborations they have, like with BMS and Vertex, those are opportunities too. They bring in funding and external expertise.
Big markets. Growth in their chosen niche, platform potential, key partners. Okay, that helps balance the weaknesses. Now for the final piece. The threats. What could derail this?
The threats are also substantial, numerous. Competition is intense. You've got companies like CRISPR Therapeutics and Bluebird Bio who already have approved ex vivo gene therapies on the market for sickle cell and beta thalassemia, the very diseases Renacell targeted.
So they're already behind competitors in that specific area, even if they went back to it.
Right. And in the in vivo space they're now pursuing, other companies like Intellia Therapeutics are also advancing their own programs, and some are arguably further along in clinical development than Editas is. Then there's just the inherent difficulty of drug development.
Along an uncertain path.
Exactly. Years of multiple expensive clinical trial phases, and the failure rate in biotech is notoriously high. Most drug candidates that enter trials just don't make it to market. That's a fundamental threat.
What else? Regulatory hurdles.
Big time. The regulatory environment is complex. You might get different feedback or requirements from the FDA in the US versus the EMA in Europe, which can complicate things. And then there are the technical challenges inherent to gene editing itself.
Right.
Concerns about off-target effects, accidentally editing the wrong part of the DNA. The risk of the patient's immune system reacting negatively to the therapy components, that's immunogenicity. And just the basic challenge of reliably delivering these editing tools to the right cells inside the body without causing problems. These are industry-wide hurdles.
So, broader risks beyond just Editas.
Definitely. Add to that regulatory and legislative uncertainty around gene editing, public perception, and ethical concerns, big questions about pricing and getting insurance companies to pay for these potentially very expensive one-time therapies. Oh, and the sheer complexity of manufacturing these advanced therapies consistently and at scale, it's a minefield of potential threats.
Wow, okay. That really lays out the difficult terrain.
Yeah.
So summing up this whole risk assessment section for the listener.
The sources basically paint this picture. The science is undeniably exciting. Editas has strong IP, a promising early platform technology, that encouraging primate data. The market opportunity is huge, especially where they're focused now, in vivo. But the risks are equally massive, maybe even more so.
Because the pipeline is so early.
So early stage, no revenue, burning cash fast. They face intense competition, some of whom are ahead. And they have to navigate all those technical, clinical, and regulatory hurdles where, historically, failure is more common than success in biotech. Understanding that stark balance, the huge potential versus the very real, very significant risks, that's absolutely crucial for evaluating Editas.
That brings us perfectly to the conclusion, Chapter 7, Conclusion and Hook Reveal. Let's tie it all together, especially through that value investing lens we started with.
Right. So the sources essentially wrap it all up. They acknowledge that the strategic pivot to in vivo was, a bold move by management, probably pragmatic, focusing limited resources on what they saw as the best long-term bet. But despite that, Editas Medicine remains, according to this analysis, a highly speculative investment.
Highly speculative. Why that specific label from a value investing standpoint?
Because when you look at it through that traditional value lens, the kind Buffett uses, emphasizing predictable earnings, a strong competitive advantage or moat, a clear path to profitability, Editas just doesn't check any of those boxes. Not even close.
Because it's preclinical, losing money.
Exactly. Preclinical stage, consistent big losses, negative cash flow. Its entire value today is tied up in future events years down the road that are completely uncertain. Will the trials work? Will the FDA approve it? Can they actually sell it against competitors? You just can't predict it with any reasonable certainty.
So the current stock price isn't reflecting the company's current financial reality or assets.
No, the sources are very clear on this point. The market value isn't based on fundamental earnings power today. It's driven purely by speculation on the potential of their technology and future success. The analysis actually describes valuing Editas right now as being like buying a call option on a future scientific breakthrough.
A call option.
Oh.
A bet on future upside, basically.
Pretty much.
Yeah.
And because of that, the analysis concludes it's really only suitable for investors who have a very, very high tolerance for risk, people with a long-term view who are essentially making a calculated gamble on major scientific and commercial success down the line. It is not, the sources stress, for a traditional value investor looking for predictability and a margin of safety based on current fundamentals.
And that brings us right back to the hook we started with. The science itself, editing DNA, it is potentially world-changing, transformative medicine.
Absolutely. The potential is immense. But the investment reality, at least for Editas Medicine today, based on this June 2025 analysis, is one of high speculation, high uncertainty, and very significant risk. That exciting potential is what fuels the optimistic analyst targets and gets people interested. But the financials, the early stage, the competition, the hurdles, they make it unsuitable for a conservative, value-based approach.
Transformative science, speculative investment. That's a really powerful distinction the sources draw out. And that really wraps up our deep dive into Editas Medicine today, pulling out those key insights directly from the source material we were given.
Yeah, we've covered quite a bit. That huge strategic pivot to in vivo, the experienced team trying to execute it, the tough financial picture with that crucial cash runway, the market's split personality on the stock, the ownership, and that big balance of exciting potential versus really daunting risks.
So let's leave you with a final thought to chew on, something building on everything we've discussed from the sources. Here it is. Given that promising early preclinical data, remember that 58% editing in primate blood stem cells, hitting a potentially therapeutic level, how do you weigh that against the really long timeline? With human trials maybe not even starting until 2026 and all those significant risks we talked about, clinical failure, fierce competition, regulatory roadblocks. How much did that potential future breakthrough outweigh the current financial realities and all those uncertainties when you're thinking about this as an investment?
Yeah, that's really the fundamental question, isn't it? It's at the heart of trying to value any of these pioneering early-stage biotech companies.
Definitely something to think about. Consider which parts of this deep dive resonated most with you or maybe sparked some new questions. And just a reminder, if you want prioritized analysis and deep dives like this focused on tickers you care about, check out Stock Analytics AI over on YouTube. Members can suggest a ticker, and we'll prioritize digging into the analysis for you.
And as always, please remember, everything we've discussed today is based strictly on the source materials provided to us. It's purely for informational purposes. It's absolutely not financial advice.
Definitely not. Always consult with a qualified financial advisor before making any investment decisions. Research and AI disclaimer apply. Thanks so much for joining us for this deep dive.
Yeah, thanks for tuning in.
Stay tuned for more deep dives into complex topics coming soon.